Why would someone pay to buy oil? How does that work? Let's talk about oil futures. What's happening, everyone? Welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, money management tips, and all things finance. If you're new to the channel and finance is your thing, consider subscribing. In this video, I'll talk about how oil futures work and try to explain the madness we experienced when oil prices went negative. There are multiple factors that influence oil prices. Two big ones are, number one, OPEC, or Organization of the Petroleum Exporting Countries. They control 42% of the world's total crude oil output. With such a massive control on supply, OPEC has the ability to influence prices. By increasing or decreasing supply, OPEC can push the price of oil up or down. Number two is the sentiments and speculation in the oil futures market. I did a separate video talking about oil crisis, price war between Russia and Saudi Arabia, and how we got here. Link on the screen if you want to learn more about that. In this video, I'll focus on oil futures and how speculation drives oil prices. WTI is the benchmark price for US oil, while Brent oil represents global oil. Oil futures are standardized exchange-traded contracts in which the contract buyer agrees to take physical delivery of a specific number of oil barrels from the seller at a set price on a set future delivery date. Consumers, example airlines, can manage crude oil price risk by purchasing crude oil futures. Businesses that require crude oil to run their business use oil future contracts to secure a purchase price for oil. Crude oil futures are also traded by speculators. They buy crude oil futures when they believe that crude oil price will go up. Conversely, they will sell crude oil futures when they think that the crude oil price will fall. More than 95% of oil contract traders are speculators as opposed to consumers, meaning they have no intention to buy physical oil and instead are looking to profit from oil futures price movement. When investors talk about oil prices, they're usually talking about oil futures contract prices. These contracts are monthly and come with an expiration date. So when you hear about oil prices on Yahoo or Bloomberg, they're talking about oil prices for the upcoming month. On April 20th, 2020, the future contracts for May delivery of WTI oil tumbled to minus $37 a barrel. The May contract was scheduled to expire next day on April 21st, 2020. Traders were paying money to investors for buying May oil delivery. Why would a seller pay money to an investor to buy their oil? Remember, I talked about traders who buy oil futures contracts as a way of betting on price movements, but have no intention of taking delivery of the barrels. On April 20th, 2020, these traders got caught by sharp price drops and were forced to sell contracts at a loss. For them, selling at a negative price was better than taking delivery of actual oil because nobody needs it given lack of demand and no places left to store oil. But why did the oil price drop? With global economies in shutdown mode, increased oil production and scarcity of storage space, demand for oil has plummeted, resulting in dramatic dip in oil prices. Yes, OPEC agreed to curb the supply, but it was considered too little, too late. Again, I did a separate video on oil crisis where I go into much more detail. Link will be in the description. Does that mean we should experience a similar drop in WTI June futures contracts? The WTI futures contracts for June delivery was at $20 a barrel on April 20th. Right now, it is somewhere around $15. With lack of demand and storage constraints, chances are June contracts may also turn negative. Bottom line, unless demand turns around, it's gonna get really ugly when it comes to oil prices. Okay, that's all I have, guys. Thanks for tuning in. If this was helpful, hit that like button, and if money gets you going, consider subscribing. Until next time, peace.